Recent financial statements for Madison Company are given below. Account balances at the beginning of the company's fiscal year were AR 140 and inventory 260. All sales were on account. So I've got my assets and my liability to shareholders' equity in my balance sheet, my income statement. First thing we want to do is compute the gross margin percentage. I've got that formula right here. It's gross profit divided by net sales times 100. So we have our gross profit being right here, our gross margin. That's our sales, that's our cost of goods sold. 840,000 divided by our sales is 2.1 million times 100. And that equals 40%. So 40% gross margin percentage. That means we get to keep 40% of any product we sell in this company after we account for the cost of goods sold. What is our current ratio? Again, have that formula here. Current assets divided by current liabilities. So our current assets need to be, oh, sorry, they're already added up, 490,000 divided by our current liabilities, which are right here, which is 200,000 and we get a current ratio of 2.45. Now our acid test is similar, but it's going to be our quick assets, which is going to exclude our merchandise inventory and our prepaid expenses. So it's just AR and cash, which 160 plus 21 is 181. And I'll just put the formula here on. Our acid test is our quick assets, which is our current assets minus our inventory and minus our prepaid expenses, divided by our current liabilities. So quick assets divided by current liabilities. And so we said it was 181,000 divided by our current liabilities of 200,000, and we get a 0.91 acid test. So if push came to shove, we cannot immediately, if all of our current liabilities had to get paid, immediately cover them. The next one is our average collection period. So our average collection period is our average accounts receivable divided by our net credit sales times 365. So it's our average AR divided by our net credit sales times 365. So what is our average account receivable? Yeah, that's right. We have accounts receivable at the end of 160, and at the beginning of the year we had 140. So we can assume that it's usually between 140 and 160, which would average 150,000. So 140,000 plus 160,000 divided by 2 divided by our net credit sales. Now all of our sales are credit was what we were told. 2.1 million. Times 365. And what we get is 26.1 days. So this is how long it takes for us to collect our accounts receivable. Because we typically have 150,000, and so 150,000 divided by 2.1 million, because that's what we do in a year, gets us our percentage of, and we can multiply that by the days in the year. Our average sales period is going to be very similar. Our average sales period formula is our average inventory divided by our cost of goods sold times 365. Our average inventory divided by our COGS times 365. And again, our inventory ended at 300, started at 260. Divided by 2, because it's going to get us to 280, which is the middle of this range. Divided by our cost of goods sold, which is on our income statement at 1.26 million. And we get 81.1 days. So that's how long it takes for us to receive, from receiving to selling our inventory. Our next is our debt to equity ratio, which is our total liabilities divided by our shareholders' equity in this case, or our total equity. And here we've got total liabilities of $500,000 and total shareholder equity of $800,000. Which equals 0.625. Our times interest earned ratio is our earnings before interest and tax divided by our interest expense. Now our EBIT can be found on our income statement here because we have our tax and our interest here. So our operating income is what we're going to be using because that's our earnings before our income, interest, and tax, which equals 180,000 $180,000, and our interest expense is $30,000, which gets us a times interest earn ratio of 6, meaning we can afford the interest. And finally, our book value per share is our total equity divided by our shares outstanding, and we get total equity of $800,000, and we have 20,000 shares outstanding, which means we have a $40 per share value, book value per share.
And if the preferred equity is given, then we subtract it from the equity, right? In this question, it's not given.